Welcome to our exciting exploration of Big Money Thinks Small: Biases, Blind Spots, and Smarter Investing by Joel Tillinghast. We're thrilled to have you here as we dive into the insightful world of investing strategies and the common pitfalls that can trip us up. If you enjoy what you see, don't forget to give us a thumbs up and subscribe for more engaging content. Now let's jump right into the fascinating concepts of the book. In this introduction, we explore the key themes of Chapter 1, titled, It's a Mad, Mad World. The chapter emphasizes how our beliefs influence our entire decision-making process, ultimately shaping our destiny. It acknowledges the universal desire for wealth, while recognizing the complexity of motives behind investment choices. The author highlights the importance of learning from mistakes and shares personal experiences to provide valuable insights. Additionally, the chapter underscores the dynamic nature of the investment landscape, suggesting that what worked in the past may not necessarily work in the future. This sets the stage for a deeper exploration of investment strategies and behaviors. This frame delves into the complexities of investment decisions and market behavior. Investors frequently grapple with two fundamental questions: what happens next? And what's it worth? The chapter explains that market reactions can be unpredictable, often leading to misguided assumptions about future performance. It emphasizes the importance of patience in determining a stock's true value, as well as the negative correlation between high portfolio turnover and investment success. Furthermore, the influence of crowd behavior on investment decisions is discussed, highlighting historical examples that showcase the risks of speculation. This understanding is vital for making informed investment choices. In this introduction, we explore the key themes of Chapter 2, which focuses on the various decision biases that affect human judgment, particularly in the context of investing. The chapter emphasizes how emotional responses can cloud our understanding of facts, leading to systematic errors. It introduces concepts like the availability heuristic, which suggests that we often rely on easily recalled information rather than comprehensive data. Additionally, biases such as recency bias and hindsight bias are discussed, highlighting how they can distort our perception of events and outcomes. Understanding these biases is crucial for making better investment decisions. This frame delves deeper into specific decision biases that impact investing behavior. Misplaced anchoring is highlighted as a common pitfall, where investors fixate on irrelevant reference points, leading to poor valuation decisions. Confirmation bias is another critical issue, as it encourages individuals to seek out information that supports their beliefs while disregarding opposing evidence. Overconfidence can lead to miscalculating risks, while emotional reactions often result in impulsive trading decisions. The importance of long-term patience is emphasized, as it typically leads to better financial outcomes. Lastly, the influence of social acceptance on investment choices is discussed, illustrating how societal perceptions can affect market behavior. In this chapter, the author emphasizes the critical distinctions between gambling, speculation, and investment. While Wall Street tends to label all participants as investors, the reality is that many are engaging in speculation without realizing it. The author warns against the dangers of unintentional gambling, highlighting that true investors gather information and manage risks differently than speculators. The chapter sets the stage for a deeper understanding of how speculation can sometimes be necessary for the functioning of capitalism, while also stressing the importance of being aware of the risks involved in financial decisions. This section delves into the nuances of speculation and investment, contrasting event-based and holistic approaches. The author stresses that thorough research is essential for successful speculation, as lack of it often leads to gambling. Speculation, when done correctly, can foster innovation and progress in various industries. Investors are encouraged to focus on long-term cash flows rather than short-term price movements. Additionally, the chapter highlights the importance of diversification as a strategy to mitigate risks, ensuring that unforeseen events do not drastically impact an investor's portfolio. This understanding is crucial for making informed financial decisions. In this introduction, we explore the key themes of Chapter 4, titled Mind Over Money. The chapter begins with a thought-provoking quote from John Steinbeck, highlighting the contrast between the traits we admire and those that lead to success in business. It discusses the differences between entrepreneurs and investors, emphasizing how their focuses and strategies diverge. The importance of diversification for investors is also highlighted, along with Warren Buffett's unique approach to investing through a limited number of opportunities. Lastly, the chapter delves into the interplay of luck and skill in achieving success in the financial world. This section of the chapter focuses on the psychological traits that define successful investors. It emphasizes the importance of trained intuition, which combines rational analysis with an understanding of patterns and future possibilities. Investors are encouraged to balance emotional awareness with logical decision-making to avoid common pitfalls. Curiosity and skepticism are highlighted as essential traits for navigating the complexities of the market. The chapter also discusses the necessity of independent thinking and the ability to accept mistakes as part of the learning process. Finally, it underscores the importance of resilience and a tolerance for ambiguity, which are crucial for thriving in the unpredictable world of investing. In this introduction, we explore the essence of knowledge and decision-making in finance. The chapter emphasizes that true understanding comes from recognizing our limitations. Quick judgments, while useful, can lead to missed opportunities and critical details. The importance of cultural context in financial decisions is highlighted, as is the need for clarity in personal goals and risk tolerance. Additionally, the chapter discusses the often conflicting interests between financial advisors and their clients, and the necessity of diversification and careful selection in managing investment risks. This section delves into the practical implications of the concepts discussed in the chapter, using Fred's story as a case study. It highlights the importance of understanding the costs and incentives associated with financial advice, as well as the potential benefits of active management over passive strategies. The necessity of risk control through diversification is emphasized, as is the need for investors to be well informed about the products they choose. The chapter warns against the dangers of complexity in financial instruments, which can lead to misguided decisions and financial losses. In this introduction, we explore the key themes of Chapter 6, titled, "It's the Simple Life for Me." The chapter emphasizes the importance of understanding the businesses in which one invests. It highlights the distinction between mere familiarity and true knowledge, warning against the overconfidence that can arise from easy access to information. The concept of a circle of competence is introduced, encouraging investors to focus on their strengths. Simplifying one's investment approach by concentrating on essential facts is also discussed, along with the necessity of avoiding industries that lie outside one's expertise. This frame delves into the key insights regarding investment strategies discussed in Chapter 6. It emphasizes that familiarity with a company does not equate to understanding its true value, which can lead to misguided investment decisions. The chapter stresses the importance of focusing on long-term profitability rather than short-term gains. It also highlights the value of research tools like the Value Line Investment Survey. The risks associated with investing in complex industries, particularly biotech, are illustrated through the case study of Dendrian. Finally, the lessons learned from AIG's collapse serve as a cautionary tale about straying beyond one's circle of competence. In this frame, we introduce the key themes of Chapter 7, Thinking Small. The chapter begins with a quote from Friedrich von Hayek, emphasizing the limitations of our understanding in economics. It discusses how gross domestic product, GDP, reflects business sales, but is ineffective in predicting stock market movements. The allure of macro investing is highlighted, as it seems easier due to the constant flow of information. However, the chapter points out that successful macro investors share traits like openness to new information. Additionally, it addresses the abstract nature of economic definitions and the enduring influence of Keynesian theory despite its shortcomings. This frame delves into the insights regarding economic predictions discussed in the chapter. It emphasizes that economic models frequently fall short in their predictive capabilities, as stock prices are more about future expectations than historical data. The importance of intrinsic value in investment decisions is highlighted, showcasing how Keynes adapted his strategy to focus on undervalued stocks rather than broad economic indicators. The efficient market hypothesis is mentioned, suggesting that predicting market movements is challenging. Ultimately, the chapter advocates for a thinking small approach, which allows investors to make clearer connections and improve their forecasting accuracy. In this introduction, we explore the key themes of Chapter 8, titled Bulls in the China Shop. The chapter emphasizes how governance affects perceptions of wealth and poverty, highlighting the importance of understanding local language and legal systems when venturing into international investments. It also discusses the varying definitions and protections of property rights across different countries, which can significantly impact investment decisions. While international investing can offer diversification, it also introduces unique risks, particularly in developing nations. Understanding local culture and business practices is essential for successful investing, especially in developed countries that often provide a more stable investment environment. This frame delves into the critical considerations for investors looking to venture internationally. Currency risks are highlighted as a significant factor that can influence returns on investments. The chapter argues that democracy and the rule of law are essential for fostering investor confidence, as they provide a framework for legal protections. Historical context is also crucial, as it shapes the understanding of property rights and their enforcement. The discussion includes the favorable investment climates often found in nations that were part of the British Empire, as well as Japan's unique corporate culture, which may prioritize social ties over profitability. Finally, the complexities of investing in China are addressed, emphasizing the challenges posed by its regulatory environment. In this section, we explore the essence of what makes a business valuable, emphasizing the importance of management quality. The chapter highlights that good managers must possess both skill and integrity to avoid squandering or misappropriating capital. The author introduces two critical markers for assessing management skill: distinctive capability and capital allocation. Companies that focus on being uniquely valuable to their customers are more likely to thrive. The concept of economic goodwill is also introduced, which reflects the intrinsic value of a company beyond its accounting figures, underscoring the importance of distinctiveness in business strategy. This part of the chapter delves into the significance of a company's character in shaping its strategy. The author argues that character is a more reliable indicator of a company's potential than its ever-changing strategies. By understanding a company's history and character, investors can better predict its future success. The text emphasizes that companies must continuously adapt to maintain their distinctiveness in a competitive landscape. Notable examples like Walmart and Geico illustrate how unique strategies aligned with character can lead to success, showcasing the importance of understanding both character and strategy in business. In this introduction, we explore the key themes of Chapter 10, titled Bang for the Buck. The chapter emphasizes the importance of capital allocation in determining the value of assets. It highlights the necessity of selecting capable stewards who prioritize fiduciary responsibilities. The author discusses how success can be measured through rate of return and present value, while also noting the limitations of historical accounting in capturing off-balance sheet liabilities. Additionally, the chapter delves into the significance of intangible assets, particularly brands, and introduces the concept of return on equity, ROE, as a measure of profit maximization. This frame discusses the intricacies of capital allocation and its impact on business growth. The author emphasizes the importance of incremental analysis when evaluating potential growth projects, particularly in the tobacco industry, where profit margins are notably high. The role of marketing spending in building brand value is also highlighted, as it can significantly influence customer loyalty. Furthermore, the chapter reflects on how historical decisions can shape current profitability. The challenges of acquisitions are addressed, noting that many fail to meet financial targets. Lastly, the frame touches on the concepts of dividends and share buybacks, which serve to redistribute wealth among shareholders. This frame introduces the chapter's theme, comparing classic depictions of villains in Westerns to the complexities of identifying fraud in finance. It highlights how fraud can often be mistaken for mere incompetence, emphasizing the importance of understanding the nuances of human behavior and motivation. The mention of the fraud triangle sets the stage for deeper discussions on the psychological and situational factors that lead to fraudulent behavior. The chapter aims to unravel the layers of deceit that can exist in financial markets, making it clear that appearances can be deceiving. This frame delves into the specific cases of Florian Hahm and Bernard Madoff, illustrating how charisma and overconfidence can mask unethical behavior in finance. Ham's story serves as a cautionary tale about the allure of high-performing individuals who may not have the best interests of their investors at heart. Madoff's operation, characterized by secrecy and exclusivity, underscores the need for transparency in financial transactions. The frame also touches on the systemic failures that allowed such frauds to occur, highlighting the critical role of regulation and oversight in protecting investors from deceitful practices. This frame introduces the key themes of Chapter 12, which emphasizes the importance of transparency in financial reporting. It highlights common accounting red flags, such as negative cash flow and bloated receivables, that can indicate potential issues. The concept of the number is discussed, illustrating how certain figures can become the focal point of scrutiny. Additionally, the role of footnotes in uncovering misstatements is emphasized, as they often contain critical information that can reveal underlying problems. The frame also notes that different stakeholders, such as creditors and shareholders, have varying concerns when analyzing financial statements, which can lead to different interpretations of the same data. Finally, the impact of accounting choices on reported earnings is mentioned, setting the stage for a deeper exploration of these themes in the chapter. This frame delves into the various types of accounting fraud and their indicators, providing a clearer understanding of how these practices can mislead investors. It outlines common fraudulent activities, such as recording sales too soon and fabricating revenues, which can distort a company's financial health. The practice of shifting expenses to future periods is highlighted as a deceptive tactic that can create an illusion of profitability. The frame also emphasizes the danger of hidden liabilities, which are often buried in footnotes, making them difficult to detect. Case studies of Friedman's Jewelers and Alu Healthcare illustrate real-world examples of these issues. Additionally, the role of auditors in detecting financial misstatements is discussed, underscoring the importance of thorough scrutiny of financial statements for potential red flags. This frame serves to reinforce the chapter's message about the need for vigilance in financial analysis. In this introduction, we delve into the key themes of Chapter 13, which emphasizes the impermanence of life and the surprising nature of commerce. The chapter highlights how investors often neglect the critical aspects of corporate mortality and certainty when valuing stocks. The discounted cash flow formula is introduced as a vital tool for stock valuation, with a focus on four essential elements: profitability, lifespan, growth, and certainty. The chapter sets the stage for further exploration of how different industries perform based on these elements, promising insights in the upcoming chapters. This frame discusses the critical insights regarding corporate longevity and value. It emphasizes that industries with higher profits and longevity are more likely to endure over time. The chapter warns against the careless application of the discounted cash flow method, stressing the importance of reliable projections for investors. Interestingly, railroads, despite their decline in market share, have outperformed other transportation stocks. The concept of local monopolies is introduced, highlighting how they can safeguard profit margins. Finally, the resilience of consumer non-durables in terms of profitability and longevity is noted, showcasing their unique position in the market. This introduction highlights the key themes of Chapter 14, which delves into the complexities of the oil market. It emphasizes how commodity producers operate in a volatile environment where prices can swing dramatically. The chapter discusses the unpredictability of production costs and the importance of managing development expenses to maintain profitability. Additionally, it touches on the influence of geopolitical factors on oil prices and the broader challenges the industry faces, including environmental concerns and social implications. Understanding these dynamics is crucial for anyone interested in the oil market. This frame summarizes critical insights regarding oil production and market dynamics. It explains the three main categories of oil production costs and how advancements in technology have enhanced recovery rates. The discussion also highlights the significance of political stability and favorable fiscal terms in attracting investments. The case of Brazil's Petrobras serves as a cautionary tale, illustrating the potential for both opportunity and risk in oil investments. Furthermore, the frame addresses the detrimental effects of corruption and mismanagement on operational costs, as well as the challenges posed by speculation in the oil markets, which can discourage long-term investment strategies. This introduction highlights the key themes of Chapter 15, which focuses on the dynamic nature of technology and the unique challenges faced by investors in this sector. The chapter emphasizes that while technology evolves rapidly, certain foundational principles remain unchanged. It also points out the absence of a singular investment figure in tech akin to Warren Buffett in traditional sectors, illustrating the complexities of tech investments. The importance of balancing innovation with cost management is underscored, as well as the necessity for investors to grasp both visionary and financial aspects of the industry. The chapter sets the stage for a deeper exploration of these themes. This frame delves into the critical insights regarding tech investments as discussed in Chapter 15. It highlights the significance of unexpected discoveries in driving innovation, emphasizing that many groundbreaking inventions are often overlooked. The narrative of unrecognized inventors serves as a reminder of the unpredictable nature of success in technology. Furthermore, the necessity for companies to adapt to evolving market conditions is stressed, as many firms face the risk of obsolescence despite early achievements. Investors are encouraged to prioritize long-term value over fleeting gains, underscoring the importance of comprehending the complex relationship between innovation and market dynamics. This introduction highlights the key themes of Chapter 16, which focuses on the critical question of how much debt is too much for businesses. The chapter emphasizes that while business failures can stem from various factors, excessive debt is often the final straw. It discusses the tendency of borrowers and lenders to overlook risks during prosperous times, leading to financial distress when downturns occur. The importance of maintaining cash reserves and flexible repayment terms is underscored, along with the necessity of adhering to sound underwriting practices and the matching principles of duration and risk in lending. This slide delves into the insights regarding debt and its implications for business longevity. It illustrates how some companies maintain high credit ratings despite having negative net worth, primarily due to strong cash flows and valuable intangible assets. The media industry is presented as a case study where stable cash flows have historically supported significant debt levels. However, the risks associated with roll-up strategies and the cyclical nature of asset-heavy industries are also highlighted, emphasizing the importance of matching funding sources to the risk profile of assets to ensure long-term viability and avoid financial distress. In this chapter, we explore the complexities of stock returns and the importance of understanding the underlying metrics that drive investment decisions. The quote from Warren Buffett sets the tone, emphasizing that forecasts are more reflective of the forecaster's perspective than the actual future. The chapter discusses how stock returns are influenced by the price paid and the performance of the underlying business. Investors are encouraged to use earnings yield as a primary metric for estimating future returns, with a focus on the advantages of low PE stocks. Understanding the market discount rate is also highlighted as a critical factor in making informed investment choices. This section delves deeper into the concept of earnings yield and its significance in stock market performance. The earnings yield, being the inverse of the PE ratio, serves as a valuable tool for investors to gauge potential returns. The chapter emphasizes that stocks with high earnings yields tend to outperform the market over extended periods, reinforcing the low PE effect. However, it also cautions investors about the risks associated with cyclical industries and the importance of management quality. Historical data supports the notion that low PE stocks typically provide better returns, making them a focal point for value investors. In this frame, we introduce the chapter titled, "Which earnings number?" The chapter emphasizes the importance of understanding different earnings definitions and their impact on stock valuation. It highlights that while earnings are crucial for determining a stock's value, the various interpretations can lead to vastly different conclusions. The focus is on quality earnings, which are closely tied to free cash flows that can be distributed as dividends. The chapter also points out that analysts frequently adjust reported results, which can sometimes obscure the true financial picture. The key takeaway is that GAAP earnings, owner earnings, and free cash flow are the most reliable indicators of a company's value. This frame delves into the challenges associated with measuring earnings accurately. It explains the differences between net income and cash flow, emphasizing that cash flow statements are essential for understanding a company's operational health. The concept of owner earnings is introduced, which is calculated by subtracting sustaining capital spending from operating cash flow. The chapter warns that adjusted earnings can often misrepresent a company's true economic situation, particularly in times of inflation or when dealing with intangible assets. The case of Valeant Pharmaceuticals is highlighted as a cautionary tale, illustrating how adjusted earnings can lead to misleading conclusions about a company's financial health. In this frame, we introduce the key concepts from Chapter 19, The Art of Judging Value. The chapter emphasizes the importance of comparing a security's price to its intrinsic value, which is typically estimated using discounted cash flows, DCF. DCF is a method that connects various financial elements such as current income, growth, lifespan, and certainty. However, the accuracy of these estimates is crucial. If the inputs are flawed, the outputs will be as well. Therefore, understanding the assumptions behind DCF is vital for investors to make informed decisions. This frame discusses the critical considerations in valuing stocks, as outlined in the chapter. Present value calculations depend on historical data, but predicting the future remains uncertain. Analysts are encouraged to classify their assumptions based on credibility to avoid value traps, situations where stocks seem undervalued but fail to perform. A practical checklist can help investors identify potential vulnerabilities in their stock selections. Additionally, diversification is highlighted as a strategy to manage risks associated with uncertain valuations, allowing investors to navigate the complexities of the market more effectively. In this frame, we explore the concept of financial bubbles, which are often misunderstood. The chapter emphasizes that bubbles are subjective and cannot be easily defined. To identify a bubble, one must focus on the intrinsic value of assets rather than predicting future movements. Historical price/earnings ratios serve as a guide to spotting bubbles. Additionally, the role of easy money from central banks is highlighted as a crucial factor in bubble formation. The chapter also discusses how bubbles can lead to irrational behavior among investors, creating a cycle of speculation and risk. Continuing from the previous discussion, this frame delves into the double bubble of the 1990s, which was largely driven by globalization and technological advancements. Deregulation played a significant role in creating a favorable environment for market optimism. The Federal Reserve's policies, aimed at stimulating the economy, inadvertently inflated asset prices. The chapter also highlights the surge of IPOs during this period, where many tech companies entered the market, often leading investors to overlook fundamental analysis in favor of hype. Ultimately, the market crash served as a harsh reminder of the unsustainable nature of these bubbles. In this chapter, we explore the two distinct investment paradigms represented by Warren Buffett and Jack Bogle. Buffett's active investing style emphasizes a deep understanding of individual securities, while Bogle's index investing approach focuses on broad market exposure. Both strategies aim to minimize regrets, but they do so in fundamentally different ways. The chapter highlights the importance of emotional character in choosing an investment path and encourages readers to reflect on their own motives and limitations. Ultimately, it underscores the necessity of maintaining a margin of safety in all investment decisions. This section delves into the key principles that guide successful investing. It emphasizes the need to manage emotions and avoid rash decisions, as exemplified by the concept of Mr. Market. Understanding one's circle of competence is crucial for making informed investment choices. The chapter also highlights the importance of investing in familiar areas and maintaining trust in financial intermediaries. Additionally, it discusses strategies to avoid competition and obsolescence, ensuring that investments remain viable in changing market conditions. These principles collectively contribute to a more secure and profitable investment journey.